Hey there, Dave Keller here with Market Misbehavior. Today we're going to talk about gold and the confluence of support. So I was first introduced to this concept of the confluence of support by Connie Brown. In one of her books, she talked about this idea where different methodologies, different approaches with different calculations all kind of coalesce to a particular signal or a particular level. And I find as my analytical toolkit involves a number of different what we call overlays, things like trend lines and Fibonacci retracements, along with statistical measures like moving averages, when I find that different methodologies with different levels that we're using, with different best practices, all kind of line up with the same general thesis, that usually to me gives me a higher conviction that a particular anticipated move may be much more likely to happen. I think we're seeing that confluence of support now with gold. We're going to look at the chart of the GLD, use Fibonacci retracements, moving averages, and classic support and resistance levels, along with some other confirmatory evidence to understand how gold may be setting up for a bounce back to the upside after a stretch of underperformance over the last couple months. Before we get to that chart of gold, if you like this sort of thinking about technical analysis, market behavior, or market misbehavior, if you will, and investor psychology, why not subscribe to my channel? Also, give the video a like if you appreciate it. We'd very much appreciate that back. Put a comment below. Do you think the next 10% move in gold is higher or lower, and why? Drop a comment, let me know. Let's look at the chart here of the GLD. Of course, a number of different ways you can play gold. Often people look at the gold stocks, things like the XAU, the GDX, or even the GDXJ, which is the Junior Gold Miners ETF. I like to look at the GLD. That is a physical gold ETF. So it's basically instead of an ETF that is capturing gold stocks like the GDX, the GLD actually holds physical gold, and so it's really a pure play on gold. Where in years prior, investors would use futures, gold futures, to actually make this bet. Now with an ETF sort of structure, much more accessible to the average investor. Now, if you look at what's happened with the GLD over the last 6 to 8 months, you'll see that it bottomed out actually in September of 2022. Now, that's after making a long-term high in March of 2022. So the GLD up in this sort of stratospheric level is similar to spot gold or the gold future getting above $2,000 an ounce. That's sort of that long-term all-time high range. That's where the GLD was in March of 2022. So this kind of coincides with gold, physical gold at around $2,000, $2,100 an ounce. You can see we pulled back to a lower in September, again retested that in mid-October, and then in early November, which ended up being the intraday low for the cycle before we rotated higher. Look at how we were below the 50-day moving average this whole time and then broke above it. And that was one of those really interesting signals telling you potentially a change of character, right? Finding support, breaking above moving average, the momentum turning more bullish with the RSI breaking above 60. All of that happened here in early November, which told us to expect a bit of a move back to the upside. Now gold continued higher, pulled back in February, March, along with equities notably, and then made a new swing high in April and in May. Now here you can see what's called a bearish momentum divergence, which you've highlighted on our channel many times. When you have price going higher, but you have momentum sloping lower, that disagreement usually indicates that the momentum underlying the price is weak, is too weak or not strong enough. As a result, we're probably at the later stages of that bull market phase. And that's pretty much what happened. Now, here's where we can start engaging the Fibonacci retracements, which I think add another layer of interesting evidence to this picture. Take the low in November, which again was the intraday low for this cycle. Take the intraday high in early May, which is around 191 for the GLD. Take a 38.2% retracement of the way back down to the low. That gives us a downside objective around 175, 176. And it's almost to the penny where the GLD bottomed out in late June. So when we got to that point, pretty much a high expectation that we'd at the very least see a reaction back to the upside, a counter trend move back to the upside, which we got. You can see the GLD bounced up to 184. That was interestingly the high from early June. That was actually high for the month of June. We came back up to that 184 level and then rotated lower. Now look at where we're at. We are pulling back to that same level of support that we found in June. So number one, we're at a consistent support level, right? So classic support and resistance is look at where we're at, look to the left. see when we've been there before, what levels have been meaningful. And if we're at a level, if you assume that buyers came in around 175 to provide this upward reaction rally, arguably a month and a half later, 6 weeks later, a lot of those investors probably still keen on buying gold right around that point, and that's the argument for a support level holding and having a similar move here going forward. Second thing, of course, is we lining that up with the Fibonacci retracement. We mentioned earlier that the pullback to that level was meaningful because it was a Fibonacci support level. That Fibonacci support level still holds because the high in May and the low in November still, I think, the appropriate framework to understand what's happening right now. So as a result, we're at that same level of support based on Fibonacci analysis. Here's the third piece. We are now at the 200-day moving average. Now, if you look back in first quarter of 2022, we were above the 200-day. We broke below the 200-day in May, tried to get it back above there, really failed to sustain any hold above the 200-day, and then broke down. That was really a confirmation of this new downtrend phase. After we broke above the 50-day moving average in November of last year, we finally got to the 200-day, chopped around there for a couple weeks, and then followed through. And from there, we haven't touched the 200-day since. Now we're back there. Now, again, while there are a number of reasons why a chart like the GLD could bottom out or could top out, the 200-day moving average is a widely followed barometer, right? It's a level that many chart platforms feature on their charts. So anyone, even someone who's not technically savvy, might bring up this chart and see the 200-day moving average. So we feel it's an important level to watch because so many other investors, including institutional investors running a decent amount of money, are looking at the 200-day moving average. So a lot of times I think it could be a bit of a self-fulfilling prophecy where stocks and ETFs tend to bounce off of a 200-day because if so many people expect that support and start making trades in expectation of that support, then you all of a sudden actually see the support play out because it's a self-fulfilling prophecy. So now we have that confluence of support. Classic support level, which we're now lining up with, that also coincides almost exactly with a Fibonacci support level, which was first tested back in June, and now we're at the 200-day moving average. So now we have three different approaches, all different calculations, all different techniques, all lining up, suggesting that around 176 is a decent place for gold to bottom out. Now, let's take a step back even further and say, if we would find a bounce here, what would we need to see to sort of confirm that that's happening? Besides the fact the price going up, which is the most important measure, we need to see improvement in these bottom two sections as well. Here's the RSI, a classic measure of price momentum. We mentioned it earlier back here with the bullish or bearish momentum divergence in the second quarter of 2023. Notice how the RSI has broken below 40. And what that tells me is this chart at the higher level is really more still in a downtrend, right? That downtrend really happened off of the peak in May. Once we broke below the 50-day moving average, the RSI got below 40 and all of a sudden has pretty much stayed in the bearish range. So the most time the RSI has been below 50, occasionally broke higher, but didn't get above much above 60 here in July on the last rally. So overall, this is the momentum characteristics, more similar to bear market phases, like in the middle of 2022, than bull market phases, like late 22 to early 23. You can see the RSI looks a lot more similar to this red shaded area than the green shaded area, just because the entire range is lower. So we're again in that same environment where overall, I think the tailwind, the overall trend is still down. But at the very least, you expect a bit of a counter trend move to the upside. So a bounce here with the momentum improving, the RSI getting above 50, ideally even above 60, would really confirm a rotation back to the upside. Finally, here's the relative performance of the relative strength, looking at gold versus stocks, the GLD versus the S&P 500. This line going up tells you that stocks, which are currently in a bit of a choppy pullback sort of phase, if that continues and gold rallies, this relative performance line should start to rotate higher, suggesting that gold may actually be a decent safe haven here in August and September in 2023 in a way it's not particularly been good at in recent history. So that is the confluence of support that I think is prevalent now on the chart of gold using the GLD, which is a pretty liquid ETF that holds physical gold. We talked about the confluence of support using three different approaches: moving averages, support and resistance levels, and Fibonacci retracements, and how to qualify what we may be seeing there with other indicators like RSI and relative strength. If you like this sort of thinking about technical analysis and market dynamics, go ahead and subscribe to my channel. Also, don't forget to put a comment below. Next 10% move in gold do you see as higher or lower, and why? Drop a comment, let me know. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, see you again soon.